Hello everyone. We were covering the accounting standard IFRS 15, that is revenue from contract with customers. First of all, we covered a brief overview of the principle-based 5-step model for revenue recognition, and then we covered step 1 of these 5 steps, that is identify the contract with customer in greater detail. The agenda of today's discussion is to cover step 2, that is to identify the performance obligation in the contract, that is distinct goods and services in the contract. Under the revenue recognition model of IFRS 15, this step is the most technical or the most difficult one. The reason is that there is no rule-based discussion in step 2, like 2 plus 2 equals to 4. We have to apply our judgments, our estimates, and depending upon the facts and circumstances of the case, performance obligation will be identified in the contract. As we already discussed in our first lecture, that every distinct goods and service in the contract would be considered as a separate performance obligation. First, let's look at the definition of performance obligation, and then we will discuss the term distinct. So the performance obligation is a promise to transfer to the customer either goods and services or a bundle of goods and services that is distinct, or series of distinct goods and services that are substantially same and have same pattern of transfer to the customer. Meaning thereby, every distinct goods or services or a bundle of distinct goods or services would be considered as a separate performance obligation. Even series of distinct goods and services having same characteristics and same pattern of transfer to the customer would be considered as a separate performance obligation. For example, if there is a cleaning company and it has a contract with its customer that it will be providing cleaning services to the customer for the next 6 months, then cleaning service is a series of services that are of the same type and have the same pattern of transfer. So this can be a separate performance obligation. Similarly, if a newspaper company contracts with a customer to deliver one set of newspaper daily for the whole year, that is 365 days. So every day one set of newspaper is being delivered, and this is series of goods that are substantially same and have same pattern of transfer. So this is the separate performance obligation. So performance obligation means distinct goods or service. We will discuss the term distinct and the criteria of being distinct in some later time. But for the time being, consider the term distinct as different. That in our contract with customer, every good and service that is different from each other, we call it distinct goods and service, and we will identify it as a separate performance obligation. So under 5-step model for revenue recognition, step 1 is to identify the contract with customer, and step 2 is to identify the performance obligation in the contract. That is, in our contract, all the distinct goods and service have to be identified as a separate performance obligation. This step is also very important because if performance obligations are not correctly identified in the contract, then the transaction price would be incorrectly allocated to the performance obligation in step 4, and accordingly revenue will be wrongly recognized in step 5. Therefore, IFRS 15 requires that at the inception of the contract, an entity should identify each distinct goods and service in the contract as a separate performance obligation. Now, sometimes the goods and service to be provided to the customer are specifically mentioned in the contract. However, at times goods and services will not be mentioned specifically in the contract. Instead, it will be driven by our business practices. I will try to explain this with an example. For example, if you go to some mobile market or some branded showroom to purchase a new mobile phone and you buy a new box packed mobile phone, generally when you buy a new mobile phone, it comes with a 12-month warranty. It means that these are two different performance obligations specifically mentioned in the contract. purchasing a mobile phone is one performance obligation and 12-month warranty is another performance obligation. Now, on the other hand, let's say you purchase a second-hand mobile phone from a mobile shop in your neighborhood. Now, the second-hand mobile does not come with any warranty by the manufacturing company. But let's say the shopkeeper in your neighborhood has a reputation in the sense that whenever a second-hand mobile phone is purchased from this particular shopkeeper, and if there is any problem within a month of purchase, then the shopkeeper repairs that mobile phone for free of cost. Now, in this case, 1 month warranty by the shopkeeper is not specifically mentioned in the contract, but the business practice of that shopkeeper had made a norm that whenever a mobile phone is purchased from this particular shopkeeper, then one way or another 1 month warranty services will also be given. So here one performance obligation is specifically expressed, that is mobile phone, and one performance obligation is implied by the business practice of the other person, that is 1 month warranty. So the concept here is to understand that the performance obligation are not only those specified in the contract, but could also include promises implied by the entity's customary business practices, published policies, specific statements that create a valid expectation that goods and services will be transferred under the contract. It is possible that in the contract, all the goods and services that will be given to the customer are specified, mentioned in the contract, and it is also possible that company's business practice, the company's business norms has created some valid expectation on the part of the customer that company will be providing some goods and services to the customer, and in this case such goods and services are implied performance obligation. Let me give you another example. Let's say you enroll for some accounting course with some institute. In this case, when you enroll for some accounting course, it is obvious that you will be provided with lectures, but your questions will also be responded on some WhatsApp group by the teacher or his assistant. You will also be provided class notes as well. This is because in this teaching profession, it is a norm that if someone offers some course to the students, then along with the lectures of the course, the tutor has to answer the WhatsApp queries as well. And along with that, tutor has to provide class notes as well. So in this case, these services might not be explicitly stated or announced, but are considered as a separate performance obligation implied by the norms of this teaching profession. There is another important point to remember here. Sometimes there are some activities that are needed to complete the contract, but that activity itself actually does not deliver any goods and services or anything valuable to the customer. In such case, such activities are not considered as performance obligation. IFRS 15 says that performance obligations do not include activities that an entity must undertake to fulfill a contract, but those activities do not transfer goods and service to the customer. This simply means that all the activities that are required to be performed under the contract are not necessarily performance obligation. There might be some activities that are needed or necessary to fulfill a contract, but those activities itself do not transfer any goods and service to the customer or does not deliver any value to the customer, then such activities are not considered as a performance obligation. Here is an example. Suppose I have agreed to build a factory for a customer at some distant location. To make things easier for my worker and to avoid their daily traveling from the main city to the distant location, I decided to set up temporary tents and washrooms at the construction site. These temporary tents and temporary washrooms are necessary to execute the construction of the factory. These facilities are crucial for carrying out the project, but they are not what I am actually delivering to the customer as a part of the contract. Let me give you another example related to internal approvals and administrative tasks. Do you know how big firms handle new client? Before accepting any new client, big firms go through a lot of checks like reviewing the client history and reviewing the client's reputation, just to make sure that firm's name and reputation is not spoiled or exposed to unbearable risk by accepting any new client. These risk management processes are important for the firm and obviously requires time and cost as well. But these processes does not offer direct value to the customer in terms of goods and services. No goods and services are being delivered to the client or the customer from these risk management processes. So these internal tasks and checks don't count as a performance obligations under the contract. Now, let's talk about the final part of this step 2, that is to identify the performance obligation in the contract. As we have already discussed, that performance obligation means goods and services that are distinct or series of distinct goods and services that are substantially same and have the same pattern of transfer. But here an important question arises. What does the term distinct mean? IFRS 15 dives deep into the meaning of distinct and lays out two conditions that need to be met so that a good and service will be considered distinct from other goods and service and identified as a separate performance obligation. Let's break it down and talk about it. It says that a good or service is distinct if it meets two specific criteria. The word "and" is deliberately placed between these criteria, highlighting that both of these conditions must be met. This means that if a good or service satisfies both the criteria, it is considered distinct from other goods and service and it stands apart as a separate performance obligation because of these two criteria. Let's look at what these criteria are. The first criteria is pretty straightforward. Customer can benefit from goods and services either on its own or together with other resources that are readily available to the customer. The nature of the goods and services should be such that the customer can benefit from them either on its own or together with other resources that are readily available to the customer. Let me give you a real life example. Imagine you are heading to an electronic store to buy a brand new 10th generation personal computer. You tell the seller that you want this specific personal computer and also want Windows 10 operating software installed in it. You buy the PC and the seller also install Windows 10 for you. In this scenario, we need to identify and determine whether the purchase of personal computer and the installation of Windows 10 operating software are separate performance obligation or a single performance obligation, whether they are distinct or not. Now, imagine if you just bought the PC, that is the hardware only, and wanted to, could you install the Windows 10 yourself? Well, if you know how to do it, yes, you can. Even if you don't know the installation of Windows 10, you could still get Windows 10 installed from any other store. It means it is possible that you purchase the hardware of the personal computer from one store and get the installation of Windows operating software from another store. This means that the PC and the Windows installation meets the first criteria of being distinct. They can be considered as a separate performance obligation because you can benefit from the PC alone and choose to get installed the Windows by yourself or by any other store. For another example, think about buying a MacBook from an Apple store, which comes with iOS already installed in it. To identify whether the hardware of MacBook and the iOS already installed in it are separate performance obligation or a single performance obligation, ask yourself, if you just bought the MacBook, could you install the iOS yourself? The answer is no. Apple products are a package deal. You get the hardware and software together and you cannot separate them. Now, the second criteria of being distinct is that the entity's promise to transfer the goods and service is separable from other promises in the contract. This means goods or services must stand out on their own, not mixed up with everything else. I repeat, the second criteria is that good or service in the contract is separately identifiable from other promise or other goods and services. This criteria is all about using your judgment. It's about looking and analyzing closely at the situation to see if things mix together or stand alone. IFRS 15 provides us with some clarification that when goods and services will be separately identifiable or when goods and services will not be separately identifiable. As per IFRS 15, the factors that indicate that two or more promises to transfer good and service to a customer are not separately identifiable include the following. Factor number 1. Entity is not using goods and service as an input to produce or deliver the combined output. Factor number 2. The goods and services significantly modifies or customize the other goods and services. And factor number 3. The goods and services are highly interdependent or highly interrelated. If in the contract, one goods and service is highly interdependent over the other goods and service, or one good and service is highly interrelated to other good and services, or one good and services significantly customize or modifies the other goods and services, or one good or services is combined with other goods and services to make a combined output or a combined goods and services, then it means that one good or services is not separately identifiable from the other goods and services. It is important to understand that what we are discussing here is not something rule based like 2 plus 2 is equal to 4. It is totally judgmental. It is totally based on the facts and circumstances of the case. Assessment of discussed factors requires our judgment and consideration of all the relevant facts and circumstances. These are the factors on the basis of which we have to assess and we have to conclude whether the goods and service in the contract are not separately identifiable from the other goods and services. IFRS 15 further states that if a promised good or service is not distinct, an entity should combine that good and services with other promised goods and services until it identifies a bundle of good and services that is distinct. It means that if a promised good or service in contract does not fulfill the criteria for being distinct, an entity should combine the good and services with other promised goods and services until it identifies the bundle of goods and services that is distinct. Once a good or service or a bundle of goods and services fulfills the criteria of being distinct, it will be considered as a separate performance obligation. Let's cover some illustration on step 2, that is identification of performance obligation in the contract. Our first illustration says that Pico Limited sells 10 washing machines for $200 each to a retailer company. Pico Limited also provides the following free of cost. Number 1, free services and maintenance for 3 years. Number 2, 10 kg of washing powder every month for the next 18 months. And number 3, a discount voucher for a 50% discount if the next purchase is made in the next 6 months. We need to identify the performance obligation in this contract. In this case, in order to attract the customer, we offer some extra goods and services to the customer without any charge. But as we know, nothing is free in the world of financial reporting. There is always some consideration against everything. For every debit, we have some credit, and for every credit, we have some debit. Similarly, if the company is charging money for one thing and giving other things complimentary, it is just to attract the customer. As per IFRS 15, transaction price will be allocated against all the performance obligation. Now, in order to identify the performance obligations in this contract, if we analyze the facts and circumstances of the case, then we can conclude that there are 4 performance obligations. Reason being, the nature of all 4 goods and services in this contract are such that they are separately identifiable from each other. Firstly, the customer can benefit from each goods and service on its own. I mean, if a customer has taken any single goods and services from the 4 things specified, it can benefit from such single good or service. Like if the customer is giving washing machine only without the repair and maintenance, washing powder or discount voucher, then also customer can benefit by using the washing machine. And if the customer is given only the washing powder, then also customer can benefit from the washing powder without other things. Secondly, these goods and services are separately identifiable from each other. You must be wondering that what kind of performance obligation is a discount voucher. See, when a company gives some sort of discount voucher against which customer can obtain discount in future purchases, that means company is promising the customer a benefit of 50% discount in the future. So the discount voucher will also become a separate performance obligation. At some later stage in IFRS 15, we will cover the accounting treatment of discount voucher under the concept called customer option for additional goods and services, but it will be covered at some later stage. Let's read the solution to our first illustration. There are 4 performance obligations as all the goods and services are distinct, because the retailer company can benefit from the goods and service on its own, and PICO Limited promise to transfer the goods and service is separately identifiable from the other promise in the contract. Following are the separate performance obligation. Number 1, delivery of washing machine. Number 2, services and maintenance over 3 years. Number 3, 10 kg washing powder over the next 18 months. And number 4, the discount voucher. Although the concept of satisfaction of performance obligation and recognition of revenue is something that we will cover in step 5, but considering the nature of goods and service in this contract, revenue against washing machine will be recognized at a point of time when washing machines are delivered to the customer. Revenue against repair and maintenance will be recognized over the period of time, that is over the next 3 years. Revenue against washing powder will be recognized over the period of time in the next 18 months, and the revenue against the discount voucher will be recognized at the point in time when the customer will avail the discount voucher or when the discount voucher is expired, whichever happens earlier. Let's see one more illustration. It says Office Solution, a limited company, has developed a communication software called CommSoft. Office Solution has entered into a contract with Logistically to supply the following. Number 1 is the license to use the CommSoft. Number 2 is the installation services. This may require an upgrade to the computer operating system, but the software package does not need to be customized. And number 3 is the technical support for 3 years. And number 4 is the 3-year of update for the CommSoft. It further says that Office Solution is not the only company able to install the CommSoft, and the technical support can also be provided by other companies as well. And the software can function without the updates and the technical support. Now, in this para, it has clarified a lot of things for us. The illustration required us to explain whether the goods and service provided to the customer logistically are distinct in accordance with IFRS 15 or not. In this illustration, it is clearly mentioned that we are not the only company that can install the software. It can be installed by other companies as well. Further, even if we do not provide the technical support, the customer can also take that technical support from other companies as well. Even if the customer do not take this software update from us, then this software can function without the software updates and the technical support. This information has clarified everything and made everything crystal clear for us that there are 4 goods and services that are distinct. Because the economic benefit of these 4 goods and services can be obtained by the customer on its own or together with other resources, and these 4 goods and services are not significantly customizing or modifying each other. Let's read the solution. It says CommSoft was delivered before other goods and services and remains functional without the updates and the technical support. It may be concluded that Logistically can benefit from each of the goods and service either on its own or together with other resources, other goods and services that are readily available. The promise to transfer each goods and service to the customer are separately identifiable. In particular, the installation services does not significantly modify the software itself, and as such, the software and the installation service are separate output promised by the office solution rather than input to produce a combined output. In this illustration, you might think that since we are providing the software and installing the software, so ultimately we are providing a combined output, that is software. But that's not the case here. Providing of solution is different thing and installing it is a different thing. Since the software is not being significantly customized in the process of installation, its installation will be considered as a separate performance obligation. In conclusion, these goods and services are distinct and amount to 4 performance obligations in the contract under IFRS 15, and revenue from each would be recognized as and when each performance obligation is satisfied. Now, let's move toward another similar illustration. But in this illustration, the facts are little bit changed. Let us read and discuss the same. An entity, a software developer, entered into a contract with customer to transfer a software license, perform the installation services, provide an unspecified software update and technical support online and telephone for a period of 2 years. The contract specifies that as a part of the installation services, the software is to be substantially customized to add significant new functionality to enable the software to interface with other customized software application used by the customer. The entity sells the license, installation services and technical support separately. The customized installation services can be provided by other entities as well, and the software remains functional without the update and the technical support. We have to identify the performance obligation in the contract. Now, looking at the facts of this scenario, we can assess and we can conclude that there are 3 performance obligations in this contract. Number 1 is the software and its customized installation. Number 2 is the software updates. And number 3 is the technical support. Now, how can I conclude that there are 3 performance obligations in this contract? First of all, the software is functional without the technical support and the software update. This means that benefit of the technical support and software updates can be taken separately, and these are separable and a separate performance obligation. You must have identified this by yourself, but you must be wondering how the software and its customized installation is a one performance obligation. In the previous illustration, we have identified the software and its installation as different performance obligation. But in this illustration, the software and its installation are one performance obligation. In this illustration, it is also again mentioned that we are not only one who does the customized installation. The customized installation services can be provided by other companies as well. This means that customer can benefit from the software together with other resources that are readily available to the customer. But customized installation is not separable from the software, because in customized installation, the software developer will significantly customize the software, significantly modify it and add new features to it. Because of this, customized installation and software will be considered as a separate performance obligation. So in this illustration, the customized installation can be done by our company or by any other company. This means that customer can benefit from the software together with other resources that are readily available to the customer, and the first criteria is being met. But the customized installation is not separately identifiable from the software. In customized installation, software will be significantly modified, new functionalities will be added. That means that the second criteria is not being met here. One good or service is significantly modifying or significantly customizing the other goods and services. Therefore, we have 3 performance obligations in this contract. Number 1 is software and its customized installation. number 2 is software updates, and number 3 is the technical support. After this, we have another simple illustration. It says ECL has entered into a contract with K Brothers for construction of a residential project including supply of construction material, architectural services and engineering and site clearance. ECL and its competitors provide such services separately also. In this illustration, we have a company called ECL. It has contracted with K Brothers for the construction of the residential project. In this contract, we have to supply the construction material, we have to provide architectural services, and we have to provide the engineering and site clearing services. The illustration also says that we, the ECL, or its competitors provide all these services separately. Now, even though ECL or its competitors can provide all these services separately, but in the given illustration, with all these services, ECL is constructing a residential project. This means that all those services together are forming a single combined output. These multiple goods and services together are forming a single combined output. So there is only one performance obligation in the contract. In the illustration, different services like construction material, architectural services, engineering and site clearing services being performed under the contract are separately identifiable. I hope I have been able to explain this step clearly to all of you. I hope that I have been able to discuss all the things well. I wish you all the best today. Thank you for watching.